Alright, so here we've been given the statement of profit or loss for the year ended 31st December. Let me zoom in. Okay, so here let's put this back. Yeah, so I've got all this information here, and they're asking us to calculate the following ratios. Okay, so the first one is the return on year-end capital employed. Okay, so first let me explain what capital employed is. This is the long-term financing used by a business to purchase, especially mostly non-current assets. Okay, it's the long-term financing for purchasing non-current assets. That is what you call capital employed. Okay, so capital employed includes total equity or total capital and non-current liabilities. Okay, colleagues, capital employed is total equity and non-current liabilities. Current liabilities are not part of capital employed. Okay, yes. So we look in our balance sheet. You look, okay, with the equity section, total equity 44,000 here. Total non-current liabilities 38,400. Okay, so okay, my total equity and total non-current liabilities. So you're going to get 82,400 kwacha. That is your capital employed. Okay. And one more important thing which you must know, okay, in your balance sheet, always remember capital employed, CE, must also equal to your net assets. This thing sometimes the way it is. Yeah, capital employed must always equal net assets. Okay, so net assets is just your total assets minus your total current liabilities. Okay, so sometimes some questions you might not see the total equity clearly or non-current liabilities, and if they ask you, okay, calculate return on capital employed, you can just say, okay, I can find my net assets, that will be equal to my capital employed. So it's just your total assets minus your current liabilities, which you still get 82,400. Okay, so that's just a point I need you to remember. What you can calculate the capital employed, total equity plus non-current liabilities, or total assets minus current liabilities. Both figures are going to give you your capital employed. Any questions before we move further? Okay. Then we also need to get our operating profit. Okay, because return on capital employed, sometimes you might see they might use the net profit, they might use the profit before tax. Okay, but usually always get your operating profit. Okay, what this ratio is telling us is just telling us from this money that we've obtained from long-term financing, which is our capital employed, how much are we getting in terms of profit? How much are we getting back in terms of profit? Okay, from this money which we've got for our long-term financing, which we've invested, how much are we getting back in profit? That's what return on capital employed is asking. Okay, yes, so operating profit is just your, here in this case here is just, we can look in our balance sheet, in our income statement here. Okay, so just subtract gross profit minus operating expenses. Okay, that's how you get to your operating profit. Gross profit minus operating expenses. Okay, so 12,000 minus 1,920, you're going to get 10,080 kwacha. Okay, so now we can find the return on capital employed. Operating profit over capital employed times 100. Right, so 10,080 divided by 8, it's 2,400. Just make sure my figures were correct so that people who are used to just swattering answers, you don't swatter the wrong answer. Yes, get 0.122, which is 12%. 12.2%. So what this is telling us, colleagues, for every 1 kwacha invested in the business, okay, in terms of the capital employed, because that money you're using to invest for the business. So for every 1 kwacha invested in the business, you generate 12.2 ngwe in operating profit. Okay, for every 1 kwacha you've invested in the business, you are getting back 12.2 ngwe in operating profit. Any questions? Yes, any questions, queries? Okay, the next one is the net asset turnover. Okay, net asset turnover. So we've already got our net assets. Okay, just now if you've got your capital employed, you've also got your net assets, because they're always supposed to be equal. Okay, so basically this is just asking how much revenue are we generating from our assets. Okay, net asset turnover. In simple words, how much revenue are we generating from our net assets? Okay, so it's your revenue divided by your net assets. Okay, so our revenue according to this question, sales revenue 96,000 divided by 82,400, we get 1.17. So basically what this is telling us is the company generates 1.17 kwacha of revenue for every 1 kwacha of assets it owns. Okay. Yes. For every 1 kwacha of the assets you own, you are generating 1.17 kwacha in terms of revenue. So think of it, that's how much revenue your assets are bringing you, in short. Yes. Any questions? I hope we're not dozing. Let me make sure we're not dozing. Madam Yande, any questions? Mr. Sunday, any questions?
No questions, sir.
Mr. Stern?
Following, sir.
Mr. Ronald? Mr. Douglas?
I'm there.
Okay. Madam Agnes?
So for this question, you just get the values from the table there.
Yeah,
Like,
from here.
okay. Like why I ask? Because there are certain questions where you actually have to, after you do the trading profit and loss account, according to the way things will be put, that is where you get to find the values that you need to put in there. There are such kind of questions where you have to find those values before you can put, instead of just getting them direct already made and then.
Oh.
I don't know if you understand what I'm trying to.
You're saying that you have to calculate all these values basically by yourself, huh?
No, I don't know how I can explain it, but there are certain questions. There are certain questions for instance, where first you have to do the trading profit and loss account and the other things. Then from those values that you are going to be getting, that is when now you start adding them. They are not.
No, do not worry, you won't encounter such. Okay. You won't encounter such. Okay. So when you go to the next ratio, gross profit margin. Okay. In simple words, think of it as saying, out of your sales revenue, what percentage is gross profit? Okay. Out of my sales revenue, okay, this month, out of this 96,000 sales revenue, what percentage is gross profit? Okay, because all of this revenue is not yours. There are some expenses you need to deduct out. Okay, so you want to find out of this money I made in terms of sales revenue, what percentage is gross profit? Okay, so it's just your gross profit divided by your sales revenue. I believe in this question gross profit was given. $12,000. Yes. So 12,000 divided by sales revenue 96,000. Okay, gets 0.125, which is also equal to 12.5%. So basically, out of this 96,000 kwacha sales revenue, 12.5% is gross profit. Another way you can look at it, the company makes 12.5 ngwe of gross profit for every 1 kwacha of sales. So for every 1 kwacha you make in sales, 12.5 ngwe. or maybe let's say 13 ngwe to make life easy. For every 1 kwacha you make in sales, 13 ngwe is your gross profit. Any questions? Okay, similar with operating profit margin. One way you can look at it, out of your sales revenue, out of this 96,000 kwacha, what percentage is operating profit? Or for every 1 kwacha you make in sales, how much is your operating profit? So it's that's your operating profit divided by your sales revenue times 100. So 10,080 divided by 96,000, you get 0.105, which is 10.5%. Okay. So the company makes basically 10.5 ngwe. For every 1 kwacha sale you make, 10.5 ngwe is operating profit. Okay. For every 1 kwacha you make in sales, 10.5 ngwe is your operating profit. Okay. Or out of this 96,000 you made in sales revenue, 10.5% is operating profit. So these 4 ratios here, return on capital employed, net asset turnover, operating profit margin, these are your profitability ratios. Okay, profitability ratios, how good your company is at making profits. So those are profitability ratios. Okay, with these ratios you want them to be as high as possible. You saw with return on capital employed, out of the money that you've invested, how much are you getting back in operating profit? We saw with net asset turnover, with the assets that we have, how much are we earning in terms of revenue? Okay, gross profit margin and operating profit margin, out of every 1 kwacha sale, how much are we making in gross profit? How much are we making in operating profit? Then, or any questions before we go to the next ratios? So these are liquidity. Yes, any questions? Okay, let me just grab a bottle of water. When you talk this much, okay, I'm not a papa, so I'm not used to talking for 2 or more hours. Okay, men just use usually 1 hour 30 minutes and below. But once you start reaching the 2-hour limit, you're always advised have a bottle of water or have some mint sweets. You know what will happen if you don't have a bottle of water and mint sweets after talking for 1 hour 30 minutes? Colleagues, do you know what will happen? Your mouth will be dry. Okay, you'll be thirsty. It's bad. It's not a good feeling. So let me just grab a bottle of water. Okay, we can resume. So any questions on the profitability ratios before we go to the liquidity ratios? All right, so the next ones are the liquidity ratios. Okay, converting your current assets into money so that you can pay off your current liabilities, basically. That's what liquidity is about, right? Liquidity is just about how you can convert your current assets into actual money. How fast you can convert them into actual money so that you can pay any outstanding liabilities or expenses. Okay, so we'll start with the current ratio. Okay, the current ratio in simple words is just saying can you pay all your current liabilities with your current assets? Okay, that's what it's just basically saying. Can you pay all your current liabilities with your current assets? Okay, so these liquidity ratios, any number greater than 1 is good. Okay, it signifies that you can take care of your current liabilities with your current assets. Okay, so any number greater than 1 is good. Okay, any number less than 1 is it's not a good position to be in. It signifies that you cannot cover all your current liabilities with your current assets. Okay, so we go to our balance sheet, we look for our current assets, total 40,000. Current liabilities, total 32,800. Okay. Yes. So you just say 40,000 divided by 32,800. You get, yes, approximately 1.22. Okay, so there are many ways you can interpret this. You can say like our current assets can cover our current liabilities 1.2 times. Okay, or you can say you have 1 kwacha 22 ngoe in current assets for every 1 kwacha of current liabilities. But basically what this should just signal to you is any current ratio above 1, it just means okay, your current assets, you can cover all your current liabilities and probably even remain with some change. Yes, any questions? Okay, we've now got the quick ratio. Now here what we're saying is that if we exclude inventory in your current assets, can you still take care of your current liabilities? Okay, if you exclude inventory from your current assets, you exclude inventory out, can you take care of your current liabilities? So also with the quick ratio, a quick ratio of greater than 1, it means you can cover all your current liabilities with your current assets, excluding inventory. You don't even need to sell inventory to cover your current liabilities. Okay, a quick ratio greater than 1, you can cover your current liabilities without selling inventory. Okay, just imagine ShopRite taking care of all its current liabilities without selling anything at the counter. Okay, so in your current assets you deduct inventory. Okay, so on our balance, in our financial statements, it was 16,000, so you're going to say 40,000 minus 16,000, you get 24,000, I should believe. Yes, you get 24,000. So 24,000 divided by 32,800, 0.73. Okay, you can show it as a ratio to 1, but I just like leaving it as a number, just like this. So since this value is less than 1, you cannot cover all your current liabilities without selling inventory. You will need to sell some. You will need to sell inventory basically, so that you can be able to cover these current liabilities. Okay. Yes. So this current ratio of 0.73, not good. Okay, not good. Yes. Any questions? Those are the major two liquidity ratios. There's also the cash ratio, where you do cash over current liabilities, where you say, can my cash take care of all my current liabilities? There's also the cash ratio. Yes. Any questions before we now look at the efficiency ratios? Okay, so efficiency ratios. Efficiency is all about minimizing waste. Okay, minimizing waste of resources. So these resources which we're looking at here are inventory, trade receivables, and trade payables. How well does our company manage these resources? Okay. So the closing inventory holding period basically is just asking how long does inventory have to sit before it's all sold out. Okay. So with these these efficiency ratios, especially inventory and trade receivables, you want the days to be low. Okay. As a company, you want inventory to be moving fast, because if the faster it moves, the more money that comes in. The trade receivables, you want to be collecting the money from people who owe you fast, so that you don't run the loss of bad debts, okay, or delayed payments. Okay, so we start with the inventory holding period. How long does our inventory have to sit before it's sold out? Okay, so this is the formula here. Inventory divided by cost of sales times 365 days. Okay, in our financial statements, inventory 16,000, cost of sales 84,000. So 16,000 divided by 84,000 times 365, you get 70 days. Okay, so basically you purchase your inventory, after 70 days you run out, you need to buy more inventory. Any question? So the lower the days, the better it is for you. Okay. Yes. Now this is a theoretical ratio. It doesn't mean necessarily that every time it's 70 days. No. You're just giving a, how can you say, just trying to find a benchmark for the company and say, okay, maybe the way it is, it looks like it takes 70 days for these people to hold their inventory before it's all sold out. Okay. But in reality, you find maybe it's even more than 70 days. Maybe it's even 100 days. Okay. Yes. Any questions before I go to the trade receivables collection period? Trade receivables collection period. How long does it take for us to collect money from the people who are owing us? Okay. Yes. You have to collect money as fast as you can so that you have liquidity within the business. You're able to pay for any liabilities or any expenses that fall due. The longer it takes you, the risk of bad debts. Okay. And you might even need to increase your provision for bad debts also. Okay, so it's just the trade receivables divided by the sales revenue times 365. So 19,200 divided by 96,000 times 365. It takes approximately 73 days to collect the money that's being owed to us. So you would advise this company to lower the number of days. Okay, try to collect as fast as you can. Okay. Also, the longer you take, you're going to lose that money out. Any questions? Okay, then trade payables payment period. How long does it take us to pay our suppliers? Remember, as a business, sometimes you can delay to pay your suppliers so that you use that money for other things, and when it comes back you can pay them. Okay, but you shouldn't take advantage of that, because the more you start delaying to pay suppliers, you destroy relationships with suppliers. Okay, they'll stop trusting you. So as a business, it's better you're paying them as quickly as possible. Don't take too long. Once you develop relationships with them, yeah, then probably you can extend the number of days it takes for you to pay back. So it's the trade payables divided by cost of sales times 365 days is 24,800 divided by 84,000 times 365. You get 108 days. And this is if you work on holidays also. On Christmas you work, on Independence Day you are working. Now if you've got public holidays, would it be advisable to multiply by 365 days? If there are days your shop is closed during the week, would it be advisable to multiply by 365 colleagues? Research on that, okay? Research on that. And then finally, gearing ratio. Basically, it's just about how much debt financing we are using. Okay. How much a company relies on borrowed money compared to its own equity to finance its operations. Okay. So as a company, it's better you're using your own money than debt. All right, it's better you can use debt, yes, but it's better you're using your own money. Okay, to investors, that can attract investors. Okay, so a company that's taking on a lot of debt, there are risks now that will be involved. Okay, so you just do out of your total long-term financing, which is your capital employed, how much is debt, which is the non-current liabilities. So the non-current liabilities, 38,400. Capital employed, money for long-term financing, 82,400. So 38,400 divided by this times 100, you get 0.466. Which is 46.6%. Which is telling us, out of this capital employed, this money that we're going to use for our business, 46.6% is debt. It's money that we are owed. The remainder is equity. Okay, so that's a good thing. If you're using more of your own money than borrowed money, as I said, to investors, that is a good thing. Okay, yes. Any questions, colleagues?